All right, let's dig into the latest quarterly results from fintech company Paysign. They just dropped their Q2 numbers, and wow, we've got a really interesting story here. A kind of tug of war between some explosive revenue growth and what's been happening with their stock price.
Okay, but before we jump in, you know the drill. We got to do the quick but super important reminder. This is just an explainer. It's for informational purposes only. It is not financial advice. So please make sure you do your own research before making any investment decisions.
All right, with that out of the way, let's get into it. The big picture for Q2. Now, whenever a company reports earnings, there's always one main question we all want to know the answer to.
And that question is, was it a quarter of growth or did they miss the mark? For Paysign, the answer is, well, it's a little bit of both, which is what makes this so interesting.
So here's the deal. The results really do tell two different tales. On one side, you've got this awesome top-line growth. I mean, revenues shot up 31% year over year to hit $19.1 million. That's a huge green flag. But then you look at the other side. Their earnings per share, or EPS, came in at just 2 cents. And that missed what the analysts were expecting by 2 cents. So you see the split? Great sales, but a little stumble on the profit side. Okay, so that 31% revenue growth is obviously the big, shiny number everyone's talking about. But to really get what's going on with Paysign, we've got to pop the hood and see what's powering that engine. Let's decode where that growth is actually coming from.
So Paysign's money really comes from two main buckets. You can see the bigger one here at 55% is their bread and butter, the plasma programs. That's their established business. But the real story, the thing you need to pay attention to, is that second slice, pharma patient affordability. Now, it's 41% of the total, which is big, but this is where all the action, all the momentum is happening right now.
And when I say momentum, I'm not kidding. That pharma segment is on fire. It's exploding with growth over 140% year over year. That right there, that is the engine driving the whole train. That's what's getting them to that overall 31% growth we saw. So here's the key takeaway. The plasma business is steady. It's doing its thing, but the pharma side, it's an absolute hyper-growth mode.
Okay, so that brings up a really good question, right? If revenue is just crushing it, why did they miss on earnings? To figure that out, we've got to put the pieces of the profit puzzle together.
So yeah, there was some pressure on their profit margins this quarter. But, and this is a big but, the company is doubling down on its forecast for the entire year. They're still guiding for a net income of somewhere between $6 and $7 million. And for adjusted EBITDA, which is a really good way to look at their core operational profit, they're expecting $18 to $20 million. So what does that tell us? It tells us the leadership team is confident. They're basically saying, hey, we're on track, and this business is still very profitable.
But you know, for any investor, what's happened in the past is interesting, but what's really important is what's coming next. So let's look ahead. What is the company's own forecast for the rest of the year?
And boom, here it is. This is maybe the most important takeaway of the whole report. The company didn't just stick with their old forecast, they raised their full-year revenue guidance. They're now expecting to pull in between $76 and $78 million. Let me tell you, raising your guidance like that is one of the strongest votes of confidence a company can give in its own business. And what does that new number actually mean in terms of growth? Well, if you look at the midpoint, it works out to about 31% year-over-year growth. Sound familiar? It should. That tells us management fully expects that incredible momentum we just saw, the momentum being driven by that pharma business, to keep on rolling right through the end of the year.
Okay, so let's recap. We have a company with solid, accelerating growth, a leadership team that's confident about the future. So, how has the stock market reacted to all this? And what's the big picture view for an investor?
This timeline, man, it really tells a story, doesn't it? Look at this. After getting flagged as a potential buy way back in December at around $2.90, the stock just went on an absolute tear. I mean, a massive run, all the way up to almost $9. But since then, as you can see, it's pulled back pretty hard, now sitting below 6. This kind of roller coaster ride, it's actually really common for smaller companies like this, even when the business itself is doing great.
So, what's the takeaway from all this? Based on these facts, The analysis suggests a hold for anyone who already owns the stock. And the thinking is pretty straightforward. The main reasons you'd have invested in the first place, those strong fundamentals, that growth story, they're all still there. The business is still on track, even if the stock has been a bit wild lately.
So let's just boil down the strategic view here. First things first, you have to remember that this up and down action is just part of the territory when you're talking about smaller companies. Second, the business fundamentals, especially that pharma segment that's just booming, they look really strong. And finally, for anyone who isn't already invested, this recent drop could actually be an interesting opportunity. The thinking is that if the stock were to fall into that $4 to $5 range, it might be an attractive entry point.
And so all of this leaves us with one big final question. On one hand, you have a business that's just firing on all cylinders, right? Growth is accelerating, management is confident. But on the other hand, you have a stock that's taken a hit and pulled back from its highs. So the million-dollar question you have to ask yourself is, are those powerful fundamentals enough to fuel a rebound for the stock? That's the story we'll all be watching.